What investments qualify for a 1031 exchange? Just sold an investment property? Well, you could be paying a big tax bill, or you can utilize a 1031 exchange and defer those taxes. Watch this video. I will show you exactly how to execute on this strategy. Have you been thinking about selling a property and wanting to reinvest the profits into a bigger property? Well, in this video, I'm going to show you exactly how to do that with a 1031 exchange tax-deferred strategy. If you're thinking about doing a 1031 exchange, then investing in the wrong type of property can cost you tens of thousands, if not hundreds of thousands of dollars. So watch this video to avoid the common mistakes that real estate investors make when doing a 1031 exchange. By the end of this video, my goal is that you know exactly what the rules are of a 1031 exchange, what types of properties qualify for a 1031 exchange, what professionals do you need to find to help you with the 1031 exchange, and ultimately how to calculate what taxes you will be saving and eventually how to eliminate tax at the end of your real estate investment career. So what qualities of a property allow for a 1031 tax-deferred exchange? And when I say 1031 exchange, I mean a 1031 deferred exchange. That is the technical term because you're selling a property and then getting 180 days to buy another property that is like kind. That's the key piece to understand here. These are the qualities of the assets that you need to be looking at. Real property, meaning land, buildings, and improvements. Real estate, not shares in a company, not shares in a REIT, not shares in a partnership. It has to be real estate for real estate. Secondly, the real estate that you're selling is of investment use and the real estate you're buying is investment use. Or your business uses the property and you're buying a property for business use. This means you're reinvesting in like-kind property. Now, what are some of the types of properties that qualify for like-kind property? Well, it doesn't mean identical property. So you do not need to sell a single-family home and buy another single-family home, or sell a commercial property and buy a commercial property. That is not what the rule means. You can sell any investment property for another investment property, meaning you can sell a retail center or an office building. You can sell an industrial building for an apartment building. You could sell a mobile home park for a storage facility. They are all rental properties and all qualify as like kind. So what are the types of commercial properties? Well, we have apartments, industrial, office, retail, mobile home parks, self-storage, car washes, gas stations, data centers. Anything you can think of that is real estate based qualifies for a 1031 exchange. Does land qualify for a 1031 exchange? And the answer is yes. As long as the land is for rental or business purposes, it does qualify and you can sell a piece of rental property for a piece of land if you're going to be developing it or using it for investment purposes. What are some other types of properties people don't think about? Triple net properties, and they can be on a land lease. So I have a Dunkin' Donuts I own in New Hampshire. I only own the land. The tenant owns the building. They have a 20-year lease on the land. They make payments to me each month for the land, and at the end of the 20 years, they no longer own the building unless they extend their lease. So that is an example where I would be able to 1031 exchange into this type of property, and the tenant pays the taxes, insurance, all the maintenance, all the management, all the expenses on the property, and the maintenance of the entire building itself, and I have a base rent, and they pay all of the rest. That's a triple net property, and they do qualify for a 1031 exchange. The benefits of triple net is very little management. You do not have to talk to the tenants. Essentially, you collect the rent, and as long as the lease has a long term, you will get a stream of income from that rent for the term of the lease. Now, the problem with triple net properties is they're very individualistic to that user. So the Dunkin' Donuts that I have, if the Dunkin' Donuts leaves, if a Starbucks takes it, they're going to tear down the building and have to build a new building on that property. So you are limited in the type of use for that type of real estate because it's so individualistic to the retail user. The nice thing is you don't have to manage the property, but the challenge is when the lease is up, you could be sitting on a vacant building for quite some time unless you have a prime piece of real estate that another user wants to come in and take the building and sign another long-term lease. That's the primary risk. The next is tenants in common. This is a qualified 1031 exchange option where you're buying into a fractional deed ownership interest of a piece of real estate. So you own a portion of the overall deed, and each owner that sits beside you owns a portion of the deed of the property, not a partnership. You actually are an owner of a piece of the deed. And then lastly, DSTs, Delaware Statutory Trust. This is a qualified 1031 exchange vehicle. Now, you are actually not a property owner. You are investing into the only qualified entity that allows you to 1031 exchange from real property into a ownership interest in a trust. And that's a Delaware statutory trust. That is the only type of trust in America that is a approved 1031 exchange option. Now, many times investment sponsors or companies will package up investment properties, put them into a DST structure, and then they're very appealing for investors that don't want to go out and find a investment property they have to manage themselves, and they will reinvest the proceeds from their sale into that DST where they own that portion of the property and get a distribution or dividend. Now, it's typically a lower return, and these investment alternatives don't typically yield a high investment return. So be careful what you invest into because they are lower yielding investment vehicles. So how do you actually execute on a 1031 exchange? Well, as soon as you sell your property, you'll have an attorney or an escrow agent handling the sale. Once the proceeds are distributed, where they hold the proceeds from the sale of your property you're selling, you cannot touch the proceeds. They're going to distribute the proceeds from their account into the qualified intermediary account. That is the key player in a 1031 exchange, and the QI, or qualified intermediary, holds those funds until you acquire your next property that you're 1031 exchanging into. You want to make sure the QI fills out the proper tax forms because you're going to need those for your tax return to fully qualify for your 1031 exchange. You're going to have to follow the timelines where you have to identify up to 3 properties within 45 days after the sale of the property you're selling, and then you'll have to close on the investment property that you're exchanging into within 180 days after the time that you sold your investment property. These dates are critical. If you don't meet those dates, you do not qualify and you do not get the tax benefits. Ensure IRS compliance. And what I mean by that is make sure if you're 1031 exchanging and your exchange happens at the end of a calendar year and you're buying your investment property in the next calendar year because it's within that 180-day period, be sure to file an extension on your taxes because you're going to need to extend that tax return to show that you did a 1031 exchange. If you don't file the extension, then you won't qualify for the 1031 exchange, and it's a fatal mistake that your CPA made. Here are 4 key questions to ask your qualified intermediary before you hire them to hold your precious investment funds. Number 1, are you bonded and insured? Number 2, do you have experience in transacting in the type of property that I'm selling and buying? Number 3, how do you hold clients' funds? Are they commingled with all the other investment exchange funds, or are they segregated or separated into a separate account? Number 4, will I have visibility into my funds? And this is the most important question to ask them is, are the funds going to be dedicated in an account that's a trust account or an escrow account that I am the owner of, that I have possession of, or at least it's in my name and it is one of those 2 types of accounts? If it's not, then it's an asset on that QI's balance sheet. And if they were to have financial trouble, go bankrupt, you would lose those funds. And lastly, how do you communicate with my CPA or my legal team? You want to make sure they have a professional on there that's going to fill out the forms, get them to your CPA so you can file your taxes in a timely fashion. What you don't do with your qualified intermediary. Number 1, you're not going to deed the property to the qualified intermediary. I've heard this on YouTube and it's crazy. Do not deed your property to any QI. Next is never let the QI own the account you put your funds into. A lot of qualified intermediaries are the owners and custodians of these funds. You do not want them to own the account that you have your investment proceeds sitting in while you're doing an exchange. Number 3, don't let your real estate agent tell you what QI to use. Don't even let your escrow agent tell you what QI to use. Make sure to qualify the QI yourself and have them meet the criteria that I laid out in this video. Lastly, invest in a good real estate CPA that focuses on 1031 exchanges, on real estate tax strategy. In the comments below, I will leave a reference for the CPA I like to use. It's really important you use a real professional who understands real estate and will help you execute on your strategy, saving you multiple thousands, if not millions of dollars, rather than being tight on the bill that you're going to pay the guy and trying to save a few extra bucks because you don't want to pay a professional. Some of the things that they can help teach you is how to do a 1031 exchange where you can receive some cash at the sale. Now, you will be taxed on some of that cash, but you can still exchange a portion of the profits into an investment property and keep cash at the closing. Also, I recommend a book by Michael Landtrip. This guy is excellent, and it's called How to Do a Section 1031 Like-Kind Exchange. It's the expanded version, $50 on Amazon. Well worth the money. I read it cover to cover. I love it. And he teaches you everything that you need to know that is advanced about 1031 exchanges. Now that you know what investments qualify for a 1031 exchange, check out the next video. I will dig into what are tenants in common structures. How do you do a 1031 exchange into a real estate fund? It's a little complex, but if you follow along, it will help you open up your investment options to find the best property or the best real estate investment vehicle to meet your strategy. Thanks.